Money at Work continuing financial education series. Today's center of conversation is around best asset classes to hedge inflation. After years of low inflation readings well below 2%, we expect to see higher inflation through the rest of the year, possibly even longer. Inflation typically rises during periods of economic growth, so it's no surprise that inflation expectations are rising at the exact same time that consumers are in a great position to start spending. Remember, the combination of savings and the supply side shock from the pandemic shutdown is causing upward pricing pressure on a lot of goods and services. In fact, personal saving rates for U.S. consumers jumped to 20.5% in January of 2021. That's a lot of extra cash that will likely get spent on various goods and services. Meanwhile, the U.S. government just issued another $1.9 trillion in additional stimulus, which creates more demand for less services and goods that are currently in the economy. Think of inflation as having to pay more for, let's say a show or a concert because it was already sold out. So here are three asset classes to consider as a hedge against inflationary times. First is equities in the stock market. Equities are valued based on, the company's revenue, earnings, and cash flow growth. And companies whose business models may be linked to sectors of the economy that benefit from inflation or are the source of inflation tend to fare better than those with the exact opposite business structure. Equities in themselves tend to keep better pace with inflation than other investments like fixed income investments, companies that benefit from higher inflation, or those that are able to pass along the higher prices. Remember, though, not all equities are in the same and act in the same way in inflationary periods. So do your homework and understand what you're buying, why you're buying it, and with proper entry and exit points for those positions. Inflation can mean interest rates might rise, which can put pressures on some stocks or the overall market itself. Next asset class is commodities. Commodities are not only the source of inflation, but they're an important driver of it as well. The relationship automatically makes commodities an effective hedge against inflation. Thus, commodity hedge inflation well in general. The higher the level of inflation, the more effective it becomes. Furthermore, it hedges particularly well when inflation is driven by food and energy prices, which are both a key source and a key force of inflationary shocks. The recovery from the COVID-19 pandemic and expected weakening of the U.S. dollar would serve as both stimulus for the overall commodity prices. You get exposure to commodities through companies that make commodities in their business model or through the commodity itself. Trading commodities on the futures market carries significant risk, and you should always understand the risk of the position and make sure it aligns with your risk tolerance. Things can move fast when you introduce leverage, so beware. And then real estate. Like commodities, different ways to gain real estate exposure, either directly through the asset or indirectly in vehicles like REITs. As inflation refers to a decrease in your buying power, an inflation hedge in investing protects you from it. An inflation hedge typically involves investing in the asset expected to maintain or increase its value over a specified period of time. That's why real estate is considered a hedge against inflation, since home values as well as rents typically increase during times of inflation. Property prices and rental income tend to rise when inflation rises. A REIT, or a real estate investment trust, consists of a pool of real estate that pays out dividends to its investors. Real estate income is income earned from renting out a property. Real estate works well with inflation. As inflation rises, so do property values, and so does the amount that a landlord can charge for rent, earning higher rental income over time. This helps to keep pace with the rise of inflation. Remember, no matter what you do, even with inflation, the end goal remains the same. The primary goal of investing is growing your assets at a greater rate than the inflation without taking undue risk. This doesn't change at all. While there are a number of factors contributing to rising inflation, the risk of runaway inflation is very low. The information in this video is for educational purposes only and it is in no way any financial advice or recommendations to purchase any of the assets mentioned within. You want more tips on finance? Stretch your thinking, create your vision, and achieve millionaire mindset.life.